Here is the scenario we're working with. Here's our timeline. This is the month of August. On August 1st, we began our period with, 20 units at $91 each. So those are purchases that happened in the previous month that went unsold and rolled over to the current month. So $91 times 20 is $18.20. And then on August 3rd, we have a purchase, 15 units at $106 each for a total of $15.90. We have our first sale on August 7th. We've sold, 20 units, 5 times 4, 20 units for $130 each for total revenue of $2,600. And then we're back to purchase. On August 17th, we bought 20 units at $115 each. Another sale, August 20th, we sold 15 units at $140 each. $2,100 is our total revenue. Another purchase on August 25th, 15 units at $125 each for a total of $1,875. Our last purchase, just 5 units at $119 each, $595. And then we've got our final sale. On August 30th, it is 25 units, big sale, 25 units at $150 each. So that is $3,750 of revenue. So here's our timeline that we're going to be working with in this problem. This is periodic LIFO. We begin with our cost flow. We look at it in units and in dollars. In units, we start with beginning inventory. There's 20 units there. That's what we started the period with. Those were from purchases in the previous period that were unsold. And then we go over to the purchase side. We've got 15 and 20 is 35. And another 15 is 50. And another 5 is 55. So there's our 55 units that we bought. So available for sale, 75 units. Those 75 units went somewhere. Either they were sold or they remain unsold. So let's look at our sales. We've got 20 units here sold. And we've got 15 units down here sold. So that's 35. We've got 25 units sold over here. So that is 35 and 25 is 60. So we sold 60 units. It's 75 available. We sold 60, 15 remaining in ending inventory. Do the same over here. Beginning inventory 1820. Our purchases 1590 plus 2300 plus 1875 plus 595 is 6360. 6360 and 1820 is our available. Our available units cost us $81.80. That $81.80 is either sold or it remains in ending inventory. We don't know the amounts. This is very important because the dollars are what are recorded in our journal entries into our inventory account. So we need to know the amounts. We use our system and our method here, periodic LIFO, to determine the amounts. The periodic system says it doesn't matter when the sales occurred. We account for them all at the end of the period. LIFO says we begin at the end of the period and we start grabbing costs. We need to grab 60 units. 60 units is what we sold. We need to grab 60 units from our available and use the costs associated with those 60 units. LIFO says we start at the end of the month with the most recent purchase and start working our way towards the oldest. Okay, so let's get our 60 units. We got 5 units here and 15 units here. So that's 20. We're trying to get 60. We got 20, we need 40 more. There is 20 units right there. So we need 20 more. There's 15 units right there. So we need 5 more. We need 5 of these. There's our 60 units. And there's our 15 remaining units. So let's figure out the cost. Let's do the ending inventory first. We've got 15 units at $91 each. $13.65 is the cost of our units in ending inventory. You can take the shortcut here. 8180 is our available minus our ending inventory of 1365. 6815 is our cost of goods sold using periodic LIFO. But let's double check that. So we're going to add up our costs. We'll start with those 5 units right there. 5 at $91 each is $455. We'll add those 15 units there. That's $15.90. We'll add those 20 units there. That's $2,300. We'll add those 15 units there. That's $1,875. We will add those final 5 units right there. That's $595. 6815. 6815. So we've got our ending inventory in dollars and cost of goods sold in dollars using periodic LIFO. Let's write the journal entries. When a merchandiser has a sale, there are 2 journal entries we need to write. The first one is the revenue journal entry. This is at the end of the month. We're going to record, let's say this was a cash sale. Cash in with a debit for the dollar amount of $2,600 plus $2,100 plus $3,750. And the credit is revenue, or we'll call it sales, for the same $84.50. That's the first journal entry. We always have to include a second journal entry for the cost. This is at the end of the month. We're going to debit cost of goods sold for the amount that we just calculated, $68.15. And the offset is the asset account called merchandise inventory for the same $68.15. What we're saying is we sold 60 units that cost us $68.15. So because we sold them, they're no longer ours. We're pulling them out of the merchandise inventory account. We do that with that credit. And we're moving them over to the income statement into the expense account called cost of goods sold. As long as we are looking at journal entries, here are the journal entries for those 4 purchases: August 3rd, August 17th, August 25th, August 28th. A debit to merchandise inventory. We bought inventory, so we're increasing that account. And let's assume this was a cash purchase, so a credit to cash. That is periodic LIFO.